Basel III.
Basel III is a global, voluntary regulatory standard on bank capital adequacy, stress testing and market liquidity risk. It was agreed upon by the members of the Basel Committee on Banking Supervision in 2010 November, and was scheduled to be introduced from 2013 until 2015. However, changes from April 1, 2013 extended implementation until March 31, 2018. The third installment of the Basel Accords was developed in response to the deficiencies in financial regulation revealed by the late 2000s financial crisis. Basel III was supposed to strengthen bank capital requirements by increasing bank liquidity and decreasing bank leverage.
General overview.
Unlike Basel I and Basel II, which are primarily related to the required level of bank loss reserves that must be held by banks for various classes of loans and other investments and assets that they have, Basel III is primarily related to the risks for the banks of a run on the bank by requiring differing levels of reserves for different forms of bank deposits and other borrowings. Therefore, contrary to what might be expected by the name, Basel III rules do not for the most part supersede the guidelines known as Basel I and Basel II but work alongside them.
Key principles. Capital requirements.
The original Basel III rule from 2010 was supposed to require banks to hold 4.5% of common equity, up from 2% in Basel II, and 6% of Tier I capital, up from 4% in Basel II, of risk-weighted assets, RWA. Basel III introduced additional capital buffers, a mandatory capital conservation buffer of 2.5% and, a discretionary counter-cyclical buffer, which would allow national regulators to require up to another 2.5% of capital during periods of high credit growth.
Leverage ratio.
Basel III introduced a minimum leverage ratio. The leverage ratio was calculated by dividing Tier 1 capital by the bank's average total consolidated assets. The banks were expected to maintain a leverage ratio in excess of 3% under Basel III. In July 2013, the U.S. Federal Reserve Bank announced that the minimum Basel III leverage ratio would be 6% for 8 systemically important financial institution (SIFI) banks and 5% for their insured bank holding companies.
Liquidity requirements.
Basel III introduced 2 required liquidity ratios. The liquidity coverage ratio was supposed to require a bank to hold sufficient high-quality liquid assets to cover its total net cash outflows over 30 days. The net stable funding ratio was to require the available amount of stable funding to exceed the required amount of stable funding over a 1-year period of extended stress.
U.S. version of the Basel Liquidity Coverage Ratio requirements.
On October 24, 2013, the Federal Reserve Board of Governors approved an interagency proposal for the U.S. version of the Basel Committee on Banking Supervision's, BCBS, Liquidity Coverage Ratio, LCR. The ratio would apply to certain U.S. banking organizations and other systematically important financial institutions. The comment period for the proposal is scheduled to close by January 31, 2014. The US LCR proposal came out significantly tougher than BCBS's version, especially for larger bank holding companies. The proposal requires financial institutions and FSOC-designated non-bank financial companies to have an adequate stock of high-quality liquid assets, HQLA, that can be quickly liquidated to meet liquidity needs over a short period of time. The LCR consists of 2 parts. The numerator is the value of HQLA, and the denominator consists of the total net cash outflows over a specified stress period, total expected cash outflows minus total expected cash inflows. The liquidity coverage ratio applies to U.S. banking operations with assets of more than $10 billion. The proposal would require large bank holding companies, BHC, those with over $250 billion in consolidated assets, or more in on-balance sheet foreign exposure, and to systemically important, non-bank financial institutions. to hold enough HQLA to cover 30 days of net cash outflow. That amount would be determined based on the peak cumulative amount within the 30-day period. Regional firms, those with between $50 and $250 billion in assets, would be subject to a modified LCR at the BHC level only. The modified LCR requires the regional firms to hold enough HQLA to cover 21 days of net cash outflow. The net cash outflow parameters are 70% of those applicable to the larger institutions and do not include the requirement to calculate the peak cumulative outflows. Smaller BHCs, those under $50 billion, would remain subject to the prevailing qualitative supervisory framework. The U.S. proposal divides qualifying high-quality liquid assets into three specific categories: Level 1, Level 2A, and Level 2B. Across the categories, the combination of Level 2A and 2B assets cannot exceed 40% HQLA, with 2B assets limited to a maximum of 15% of HQLA. Level 1 represents assets that are highly liquid, generally those risk-weighted at 0% under the Basel III standardized approach for capital, and receive no haircut. Notably, the Fed chose not to include GSE-issued securities in Level 1, despite industry lobbying, on the basis that they are not guaranteed by the full faith and credit of the U.S. government. Level 2A assets generally include assets that would be subject to a 20% risk weighting under Basel III and includes assets such as GSE-issued and guaranteed securities. These assets would be subject to a 15% haircut, which is similar to the treatment of such securities under the BCBS version. Level 2B assets include corporate debt and equity securities and are subject to a 50% haircut. The BCBS and US version treats equities in a similar manner, but corporate debt under the BCBS version is split between 2A and 2B based on public credit ratings, unlike the US proposal. This treatment of corporate debt securities is the direct impact of DFA's Section 939, that is, the removal of references to credit ratings, and further evidences the conservative bias of U.S. regulators' approach to the LCR. The proposal requires that the LCR be at least equal to or greater than 1.0 and includes a multi-year transition period that would require 80% compliance starting January 1, 2015. 90% compliance starting January 1, 2016, and 100% compliance starting January 1, 2017. Lastly, the proposal requires both sets of firms, large bank holding companies and regional firms, subject to the LCR requirements to submit remediation plans to U.S. regulators to address what actions would be taken if the LCR falls below 100% for 3 consecutive days or longer.
Implementation. Summary of originally 2010, proposed changes in Basel Committee language.
First, the quality, consistency, and transparency of the capital base will be raised. Tier 1 capital, the predominant form of Tier 1 capital must be common shares and retained earnings. Tier 2 capital, supplementary capital, however, the instruments will be harmonized. Tier 3 capital will be eliminated. Tier 1 capital, the predominant form of Tier 1 capital must be common shares and retained earnings. Tier 2 capital, supplementary capital, however, the instruments will be harmonized. Tier 3 capital will be eliminated. Second, the risk coverage of the capital framework will be strengthened. Promote more integrated management of market and counterparty credit risk. Add the CVA, credit valuation adjustment, risk due to deterioration in counterparties' credit rating. Strengthen the capital requirements for counterparty credit exposures arising from banks' derivatives, repo and securities financing transactions. Raise the capital buffers backing these exposures, reduce procyclicality and provide additional incentives to move OTC derivative contracts to qualifying central counterparties, probably clearing houses. Currently, the BCBS has stated derivatives cleared with a QCCP will be risk-weighted at 2%, the rule is still yet to be finalized in the U.S., provide incentives to strengthen the risk management of counterparty credit exposures, raise counterparty credit risk management standards by including wrong-way risk, promote more integrated management of market and counterparty credit risk, add the CVA, credit valuation adjustment, risk due to deterioration in counterparties' credit rating, strengthen the capital requirements for counterparty credit exposures arising from banks' derivatives, repo and securities financing transactions, raise the capital buffers backing these exposures, reduce procyclicality and provide additional incentives to move OTC derivative contracts to qualifying central counterparties, probably clearing houses. Currently, the BCBS has stated derivatives cleared with a QCCP will be risk-weighted at 2%, the rule is still yet to be finalized in the US, provide incentives to strengthen the risk management of counterparty credit exposures, raise counterparty credit risk management standards by including wrong-way risk. Third, a leverage ratio will be introduced as a supplementary measure to the Basel II risk-based framework. Intended to achieve the following objectives: put a floor under the build-up of leverage in the banking sector, introduce additional safeguards against model risk and measurement error by supplementing the risk-based measure with a simpler measure that is based on gross exposures. Intended to achieve the following objectives: put a floor under the build-up of leverage in the banking sector, introduce additional safeguards against model risk and measurement error by supplementing the risk-based measure with a simpler measure that is based on gross exposures. Put a floor under the build-up of leverage in the banking sector, introduce additional safeguards against model risk and measurement error by supplementing the risk-based measure with a simpler measure that is based on gross exposures. Fourth, a series of measures is introduced to promote the build-up of capital buffers in good times that can be drawn upon in periods of stress, reducing procyclicality and promoting countercyclical buffers. Measures to address procyclicality: dampen excess cyclicality of the minimum capital requirement. Promote more forward-looking provisions. Conserve capital to build buffers at individual banks and the banking sector that can be used in stress. And achieve the broader macroprudential goal of protecting the banking sector from periods of excess credit growth. Requirement to use long-term data horizons to estimate probabilities of default, downturn loss given default estimates, recommended in Basel II, to become mandatory, improved calibration of the risk functions, which convert loss estimates into regulatory capital requirements. Banks must conduct stress tests that include widening credit spreads in recessionary scenarios. Promoting stronger provisioning practices, forward-looking provisioning. Advocating a change in the accounting standards towards an expected loss, EL, approach, usually, EL amount equals LGDP-DEAD, measures to address procyclicality. Dampen excess cyclicality of the minimum capital requirement. Promote more forward-looking provisions. Conserve capital to build buffers at individual banks and the banking sector that can be used in stress. And dampen excess cyclicality of the minimum capital requirement. Promote more forward-looking provisions. Conserve capital to build buffers at individual banks and the banking sector that can be used in stress. And achieve the broader macroprudential goal of protecting the banking sector from periods of excess credit growth. Requirement to use long-term data horizons to estimate probabilities of default, downturn loss given default estimates, recommended in Basel II, to become mandatory, improved calibration of the risk functions, which convert loss estimates into regulatory capital requirements. Banks must conduct stress tests that include widening credit spreads in recessionary scenarios, requirement to use long-term data horizons to estimate probabilities of default, downturn loss given default estimates, recommended in Basel II, to become mandatory, improved calibration of the risk functions, which convert loss estimates into regulatory capital requirements. Banks must conduct stress tests that include widening credit spreads in recessionary scenarios, promoting stronger provisioning practices, forward-looking provisioning. Advocating a change in the accounting standards towards an expected loss, EL, approach, usually, EL amount, equals LGDP-DEAD. Advocating a change in the accounting standards towards an expected loss, EL, approach, usually, EL amount, equals LGDP-DEAD. Fifth, a global minimum liquidity standard for internationally active banks is introduced that includes a 30-day liquidity coverage ratio requirement underpinned by a longer-term structural liquidity ratio called the net stable funding ratio. In January 2012, the Oversight Panel of the Basel Committee on Banking Supervision issued a statement saying that regulators will allow banks to dip below their required liquidity levels, the liquidity coverage ratio, during periods of stress. The committee also is reviewing the need for additional capital, liquidity or other supervisory measures to reduce the externalities created by systemically important institutions. As of September 2010, proposed Basel III norms asked for ratios as 7 to 9.5%, 4.5% plus 2.5%, conservation buffer, plus 0 to 2.5%. Seasonal buffer for common equity and 8.5 to 11% for Tier 1 capital and 10.5 to 13% for total capital. On April 15, the Basel Committee on Banking Supervision, BCBS, released the final version of his supervisory framework for measuring and controlling large exposures, SFLE, that builds upon long-standing BCBS guidance on credit exposure concentrations.
U.S. implementation.
The U.S. Federal Reserve announced in December 2011 that it would implement substantially all of the Basel III rules. It summarized them as follows, and made clear they would apply not only to banks but also to all institutions with more than $50 billion in assets. Risk-based capital and leverage requirements including first annual capital plans, conduct stress tests, and capital adequacy including a Tier 1 common risk-based capital ratio greater than 5%, under both expected and stressed conditions. See scenario analysis on this. A risk-based capital surcharge, market liquidity, first based on the U.S.'s own interagency liquidity risk management guidance issued in March 2010 that require liquidity stress tests and set internal quantitative limits, later moving to a full Basel III regime, see below. The Federal Reserve Board itself will conduct tests annually using 3 economic and financial market scenarios. Institutions would be encouraged to use at least 5 scenarios reflecting improbable events, and especially those considered impossible by management, but no standards apply yet to extreme scenarios. Only a summary of the 3 official Fed scenarios including company-specific information, would be made public, but 1 or more internal company-run stress tests must be run each year with summaries published. Single counterparty credit limits to cut credit exposure of a covered financial firm to a single counterparty as a percentage of the firm's regulatory capital. Credit exposure between the largest financial companies would be subject to a tighter limit. Early remediation requirements to ensure that financial weaknesses are addressed at an early stage. 1 or more triggers for remediation, such as capital levels, stress test results, and risk management weaknesses, in some cases calibrated to be forward-looking, would be proposed by the board in 2012. Required actions would vary based on the severity of the situation, but could include restrictions on growth, capital distributions, and executive compensation, as well as capital raising or asset sales. As of January 2014, the U.S. has been on track to implement many of the Basel III rules, however differences remain in ratio requirements and calculations.
Key milestones. Liquidity requirements. Analysis on Basel III impact. Macroeconomic impact.
An OECD study released on February 17, 2011, estimated that the medium-term impact of Basel III implementation on GDP growth would be in the range of 0.05% to 0.15% per year. Economic output would be mainly affected by an increase in bank lending spreads, as banks pass a rise in bank funding costs, due to higher capital requirements, to their customers. To meet the capital requirements originally effective in 2015, banks were estimated to increase their lending spreads on average by about 15 basis points. Capital requirements effective as of 2019, 7% for the common equity ratio, 8.5% for the Tier 1 capital ratio, could increase bank lending spreads by about 50 basis points. The estimated effects on GDP growth assume no active response from monetary policy. To the extent that monetary policy would no longer be constrained by the zero lower bound, the Basel III impact on economic output could be offset by a reduction, or delayed increase, in monetary policy rates by about 30 to 80 basis points.
Critics.
Think tanks such as the World Pensions Council, WPC, have argued that Basel III merely builds on and further expands the existing Basel II regulatory base, without questioning fundamentally its core tenets, notably the ever-growing reliance on standardized assessments of credit risk marketed by two private sector agencies Moody's and S&P, thus using public policy to strengthen anti-competitive duopolistic practices. Basel III has also been criticized by banks, organized in the Institute of International Finance in Washington, D.C., an international association of global banks, with the argument that it would hurt them and economic growth. OECD estimated that implementation of Basel III would decrease annual GDP growth by 0.05 to 0.15%, blaming regulation as responsible for slow recovery from the late 2000s financial crisis. Basel III was also criticized as negatively affecting the stability of the financial system by increasing incentives of banks to gain the regulatory framework. The American Bankers Association, community banks organized in the Independent Community Bankers of America, and some of the most liberal Democrats in the U.S. Congress, including the entire Maryland congressional delegation with Democratic Sens. Cardin and Mikulski and Reps. Van Hollen and Cummings, voiced opposition to Basel III in their comments submitted to FDIC, saying that the Basel III proposals, if implemented, would hurt small banks by increasing their capital holdings dramatically on mortgage and small business loans. Others have argued that Basel III did not go far enough to regulate banks as inadequate regulation was a cause of the financial crisis. On January 6, 2013 the global banking sector won a significant easing of Basel III rules, when the Basel Committee on Banking Supervision extended not only the implementation schedule to 2019, but broadened the definition of liquid assets.
Further studies.
In addition to articles used for references, see references. This section lists links to recent high-quality publicly available studies on Basel III. This section may be updated frequently as Basel III is still under development.